Welcome to Sliceonomics. I'm your host, Kyla Scanlon. Sliceonomics is a podcast that focuses on the complexity of economics, media, culture, and looks at it through a human-focused lens, looking beyond numbers and into the nebulous of everyday lives and how they're shaped by these big thematics around us. Sliceonomics is in co-production with Public.com, an investing platform that allows people to invest in stocks, ETFs, treasuries, crypto, art, collectibles, and more all in one place. Scan the QR code right here on the screen or check out the link in the episode description box to learn more. Today, we're speaking with Stephen Kelly, an alumnus of the University of Wisconsin and the Yale School of Management. He is the Associate Director of Research at the Yale Program on Financial Stability, and his work focuses on financial crises and systemic risk in the United States. He writes the newsletter Without Warning. We talked about the anatomy of risk, what everyone got wrong about SVB, and how that instability still appears in the banking system, how crises happen, and what we can learn from them. I hope you enjoyed the episode. Hey, Stephen, it's so great to have you on here. Super excited to talk about financial stability and all of the other things that you do. It's a really interesting time to be in that space, considering all that's going down, I think, with like fiscal and all that and more. So I want to get into all that and talk about it. Yeah.
Sounds great.
Yeah. So I'm just going to read you your Twitter bio. You're the Associate Director of Research at the Yale Program on Financial Stability, Financial Crises, and How to Fight Them. You write a really wonderful Substack called Without Warning. Could you provide a brief background of what you do and how you got into it?
Yeah, sure. I've never had my Twitter bio read to me. It's like being deposed. Yeah, so we are really focused at the Yale Program on Financial Stability. We're sort of a small shop inside the School of Management, really focused on crisis time policy. So, there's a lot of international institutions, thousands of great economists working on prevention. And then you kind of say, okay, well, how many of you are working on what happens when prevention fails? And there's really no political capital inside, official institutions to spend too much time on that. And it's sort of like the first rule of crisis fighting is don't talk about a crisis. So we have political independence really to sort of think about those things, mainly because all the policies are really, really unpopular that work in a financial crisis, like to restart the financial system and restart a bank. You're talking about putting money into banks and like letting the bankers who screwed things up keep their jobs because they know where all the bodies are buried, and maybe not limiting executive compensation because that causes stigma to anyone taking assistance, and you want them to take assistance and things like that. So that's kind of our focus, is really what do you do in a crisis, and let's have a playbook under glass. Okay, you want to inject capital into a bank, or you want to do a massive emergency loan. How do you structure it? What actually works? And so that's kind of what we're thinking about. And obviously we've been busy. I mean, when I started this work, we were still dissecting 2008, and then all of a sudden it was 2020. And now obviously 2023, we sort of got an old fashioned banking crisis again. So
Yeah.
we're thinking about those things as well.
Yeah. And I want to talk more about your background, but just to talk about SVB, this banking crisis that happened earlier this year. I was at a dinner this weekend and somebody was like, well, I don't like that that was a government funded, taxpayer bailout. And so
Uh-huh.
when people say things like that about bailouts or protecting the financial system, how do you respond? Like what actually happened with SVB, and was that a bailout?
Um, God, the word bailout is just it's so
Loaded.
charged. I would say, the annoying answer, and maybe this is an academic answer, but it depends on who you want to know if they got bailed out or not.
Yeah.
So many of the uninsured depositors got bailed out, and there were some unpopular ones in there. Like the biggest one was this crypto company called Circle. They had $3.3 billion, obviously well over the $250,000 deposit insurance limit, and all depositors got protected. And the FDIC sort of bore those losses. The U.S. government bore those losses. There's a question of whether it's taxpayer dollars because the FDIC is funded by banks, actually. But so you could say, okay, Circle got bailed out, and you can go crazy cynical and say crypto got bailed out. But then you can also think about the person with $251,000 who got rescued. But if you were a stockholder, you got nothing. I mean, and there were some debt holders who got nothing. So like the word bailout sort of implies like somebody with a ton of money who didn't deserve it is getting money. And obviously it's more nuanced than that. But the bank failed. I mean, the execs are gone. The bank is gone, in its old form. Um, so as far as like the biggest thing with these government funded bailouts is, well, are you causing moral hazard? Are you causing bankers to think that the government's always going to be there for them? And we really don't see that. I mean, there's just so much shame in being the exec of a failed bank. Like there's so much shame in being, the person who made copies at the failed bank. Like if you have Lehman Brothers on your resume, it's just a hard thing to overcome. It's like, oh, you're toxic. So there's not a lot. I don't think there's as much moral hazard as people make it out to be when there's a bank rescue, because your bank still kind of failed, right? I mean, and everybody knows it. The SV, I get all these ads on LinkedIn still for SVB trying to make me a loan or get me a deposit saying, hey, we're still in business inside this other bank that bought them out. But that's really hard. Like it's such a toxic brand.
Yeah. And they were bought out by JP Morgan Chase, right?
They were bought
Yeah.
by First Citizens.
Okay, okay. So
Yep.
what was JP Morgan's role in that? Or did they have
So
a role?
JP Morgan bought First Republic. Yeah.
Oh, okay.
Yeah.
I got the banks mixed up.
Yep. Yep.
Okay.
Well,
Okay.
I mean, and so did the market, right? I mean, those
Yeah.
banks are the same. You know, as far as the market was concerned in March, those banks are the same, and
Right.
same with Signature, for better or for worse. They sort of had that affiliation with each other that just didn't look good.
Yeah. And when people talk, like a lot of people point to JP Morgan, and I guess for citizens as well as purchasing these banks. And I feel like this is a question you get asked quite a bit, but the worries of the monopoly in the banking system or some
Yeah.
sort of oligopoly where these big banks are getting bigger and bigger. Do you feel like that contributes to systemic risk, or are these big banks so big that they're ultimately protected?
Uh, I'd say we're a far, far ways away from a world in which we have too few banks. In the US, we have 4,500 banks, 4,500 credit unions. I mean, it's just too many. And competition in banking is a little different because you want competition, like, to make the best coffee, and a place that makes, bad coffee you want to fail, right? And let a better coffee shop come up in its wake, right? And we sort of can't think about banks like that because part of what they offer is such a public good. I
Yeah.
mean, you wouldn't want, like, I mean, think about an election and the way we like have governments. We don't have a government straight up fail, and when there is one who does, like, that's a total crisis, right? It's a catastrophe, and that's obviously the extreme of a public good. Like, imagine, like, January 6th or something like that. It's a disaster, right?
Right.
Um, so to have a bank, you can't just have, like, be like, oh well, I want JP Morgan to fail because there's, SVB is a more innovative bank, blah blah blah. It's like, okay, well, you're talking about trillions of dollars of daily transactions, basically, a utility like thing underpinning the economy. And it's worth noting too, the regulations are super strict on banks. Supervision is not something that exists in other industries to the extent, there's not like supervisors sitting at your local coffee shop, like being like, I wouldn't have made the coffee like that. Um, and so we're along, competition just can't be thought of in banking the way it's thought of in other industries. And part of the trade-off for that is, okay, we have these federal regulations, we have supervision to sort of compensate for what would otherwise be a lack of competition. And the other thing to remember is, think about the situation of the last few months where so much of the narrative is, oh, people are pulling money out of their bank and putting it in another bank. Well, take lack of competition to the extreme. Imagine there's one bank. I mean, you have nowhere to go with that money. Like, there can't be a deposit run unless you are stacking cash, like, in shoe boxes in your closet, because there's nowhere else to put that money. So that's sort of an issue too, is like, okay, we have all these small banks that aren't actually that stable, and then some sort of macro nudge comes along and people pull their money and the bank blows up.
Yeah. And when you talk about this idea of competition between banks, how do you square that with the banks being publicly traded on the stock market? Like, is that something that you think makes sense considering they can't be that competitive? Or how do you
Yeah,
think
I mean,
about that?
they're still competitors in the sense of, like, okay, we want them to. be the most profitable. I mean, they're still competing on profit, and you know, I'm sure our conversation is going to go this way of like whether too big to fail, like where that comes in. And if you're saying like, okay, neither JP Morgan or Bank of America can fail, how much competition is there really? But they're still trying to mint money. I mean, especially, you know, they got to make bonuses and there's all these expectations in finance. So there's certainly still competition. I mean, the challenge for government is, okay, can we cut off the left tail? Can we say we're gonna prevent a systemic crisis? You know, we're going to prevent that being the mechanism to pick the failing banks, and we're still going to encourage competition and capitalism and the best credit underwriting and the best services for customers. And there's a way to do that, right? I mean, banks in theory should be able to kind of fail slowly, and that's where you want competition to come into play. Is like, okay, you know, think about like some problem bank, Deutsche Bank in 2016, or like even Credit Suisse like a year ago.
Yeah.
You know, maybe there's a world in where Credit Suisse, I mean, it was kind of just failing slowly, right? It sort of blew up, you know, very romantically in March amongst all these other banks. But there is a story, there is an alternate reality where it sort of just fails slowly because it was bad at banking. Like it was just bad at avoiding scandal. And that's sort of how you want banks to fail.
Yeah. And like when we look outside the banking system too, it feels like pockets of systemic risk are popping up with like hedge funds, you know, private credit or private equity turning into private credit. How do you think of that, where it's no longer banks maybe loaning out, but private credit swooping in and talking to your local HVAC company and offering them a loan,
Yeah.
right? Yeah.
Um, yeah, I mean, it's a risk. I mean, I would say that there's an advantage to banks being the safe ones. So much of the story is like, okay, you know, we're putting new regulations on banks, and so all this funding is moving outside of banks.
Yeah.
To some extent, I don't think that's just a wash of like, oh, we're just losing sight of the risk. There's benefits in banks being the safe ones because, I mean, banks keep the deposit ledger. Banks, you know, the entire economy outside of cash runs on bank payments. Even if you're using a credit card, like ultimately a bank is sending a bank payment. Even if I, you know, take my money out and go invest of a bank and go and invest in a hedge fund, they're using a bank. They put the money in it, right? I mean, the dollars can't leave sort of banks, which keep this payments ledger that we use in the economy. Um, so there's value in them being the safest. The other thing that banks can do that no other company can do is they can raise money in 0 seconds. They can write a loan to me or you against the value of our house. And how are they going to fund it? Well, they're going to make a deposit account for me or you. So I want $100,000 loan. I go to them. They write me $100,000 loan that's now funded by my $100,000 deposit at that bank. That is something that nobody else can do. So everybody else has to go to market, which is hard in a crisis, you know, raise funds in the market, which is hard in a crisis. You have to go to a bank for a loan, which takes time, takes credit underwriting. Um, you know, best case scenario, you're getting funds the next day. And in a crisis, that's too late. So to the extent you can have banks say, yes, there's money in your account now to a big institutional fund, or a bank can use its, you know, highly rated balance sheet and say, hey, we're just going to guarantee your trading position. You're a hedge fund, we're just going to guarantee it. That's something that's unique to banks, again, as publicly traded and highly rated. The flip side of that is if a bank loses its investment grade rating, all hell breaks loose. So they can only lend out their balance sheet so much, but that is unique to banks, and that's what makes it important, I think, or makes it still a net financial stability benefit to pushing risk out of the banks and making sure the banks are safe.
So you're saying that there's a benefit to pushing some of this off to the hedge funds, private credit, et cetera. Okay. And
yeah, exactly. And that's really what banks are good at. Like what banks do best is lend to other financial companies. I mean,
yeah.
So to the extent we can push banks roll up, you know, make them more senior in sort of the economy, senior as in like more protected, senior in the capital stack,
Sure.
that's beneficial. So you can imagine, do we want a bank making a distressed loan to a retail, like a mall, or do we want a hedge fund to do that because they're super good at credit underwriting? And where does the hedge fund get the funds? It gets it from the bank. So now the bank is protected by a layer of equity at the hedge fund, its own layer of equity, So it's sort of one step removed for the bank. It sort of makes the bank one step more senior, because hedge funds and private equity firms, they got to get the money from somewhere too, and what we see is they're leaning on their banks a lot. What's called prime brokerage, it has been booming basically, and that's just really a natural output of like, okay, we're going to regulate the banks and we're going to regulate how much credit extension they can do. So they do collateralized loans to the hedge funds, and the hedge funds go out and do the credit stuff that they're supposedly so good at. And oftentimes it works. Like the Apollos of the world are really good at private equity investments, and the banks just like aren't as good at that stuff, but they're really good at lending to the Apollos of the world.
Yeah. So is this like an unbundling of how we would traditionally think of banks? Like, do you think the more that we can do this stuff, the better?
Yeah, I mean, to some degree, the risk is always that you lose track of where the risks in the economy are. But the analogy, I think, is the like pre-COVID supply chains. So we're sort of building our pre-COVID supply chains in the financial system, which was like, let's be super efficient. It makes the most sense to manufacture good in Vietnam and then do the next step in China and then do the next step in Malaysia. And then we send it to the US for something and then it goes someplace else, right? And what we found out during COVID is like, okay, if you put up dividers in between each step, now your supply chain is totally messed up and you can't get stuff from point A to point B. And, there's maybe an advantage to having a wholly domestic supply chain. So the analogy to that in the finance world is, okay, find the amount of equity that's willing to go into finance is fixed. There's some fixed amount of bank capital that the whole economy is built on. Like there's only so many bank equity investors, right? And then banks lever up and they lend to other people that have their own equity investors. So to the extent you can economize on sort of a fixed amount of equity that's in finance, economize meaning, okay, the banks aren't as good at this as Apollo, they can lever up more, and hedge funds can go like 200x leverage in a way that banks can't, and it works for them most of the time, right? That's sort of the more efficient supply chain. But then the analogy is, okay, you have the banks lending to somebody, lending to somebody, lending to somebody, lending to somebody. Okay, now there's a crisis. Where's the money? How do we get the money from the Fed to one of these entities? The Fed only knows the banks. Regulators can only see the banks. So that, I think that's sort of the COVID scenario where you've now put up walls, or you realize you need the banks to be in the economy because that's who can get money from the Fed. And you go, well, shoot, they're not actually doing the lending. So that's a challenge, I think, and that's sort of, I mean, it's changed the nature of Fed interventions to some degree already. Yeah. But yeah, I mean, that's the analogy is you have this super efficient, rock solid supply chain versus, okay, is it more fragile when the barriers go up?
Yeah. And there's so many nebulous parts, I feel like, to the work that you do. Like, what's another thing that you're watching that feels risky or feels like it could be an issue moving forward, like this as well as something else?
Yeah, I would say a couple things. I mean, one is the March bank runs have sort of been characterized as a run on unrealized losses from interest rate hikes, and that interaction with uninsured deposits, and those things made the run worse. But the run we saw, like the banks weren't random, and the run didn't happen as soon as we found out about the unrealized losses or the uninsured deposits. It happened, we sort of had this tech crypto recession that had really caused a natural deposit runoff. So like, so much of the question is about what's the loyalty or the stickiness of your depositors. Well, you can have infinitely loyal depositors, but if business is bad, they're just going to run out of money. And that's sort of what we saw in tech and VC. And then SVB comes out and says, look, our clients are burning through money. And we tried to raise capital and we couldn't do it because, who wants to lend to a tech bank in 2023 with rates at 5%, right? Mm-hmm. So the business model is sort of clearly broken. You get a run on that bank, you get a run on banks that look like it. And we never really saw a spread. Like all the banks that had problems, even like the ones that had problems into the summer, PacWest and whoever else, we had all those names right away in March. Like the resolution took longer or could last longer in some cases, but we never got like new banks. It wasn't like June came along and we're like, oh my God, Morgan Stanley's going to go down. So it really wasn't a run on uninsured deposits, which could take down every bank in America, and it wasn't a run on unrealized losses. Those factors made life harder for SVB, but that wasn't the run we saw. The flip side of that is that run is sort of still out there. Like the Fed kind of keeps surprising to the upside. Bank of America is sitting on like $130 billion of unrealized losses. Not that Bank of America is next. You have a better franchise. You have a bank that could raise capital compared to SVB, but that gets more and more fragile as if the Fed has to go higher than we think. That run is sort of still out there. It's not a base case, but it's out there. So that's a risk, I think, is that nothing's really changed about that part of the story. And if anything, it's gotten worse than expectation. So I think that's kind of a big risk that I'm watching the banking system.
Yeah. And it seems like the Fed is planning on pausing, but they keep on like playing with the idea that like we could hike if we wanted to. And
right.
So if they do that, like, do you feel like that could be, or would it be like 500 basis points more of hiking that we would start to see the cracks really begin to form?
Yeah, I mean, it's hard to say exactly where it would happen, but we probably need something else. I mean, that's the thing too, is you need one other spark or whatever, and it could be a recession. I mean, to the extent we're talking about why SVB, why First Republic, why Signature, well, you had a crypto tech recession. I mean, when you have a recession, it's bad for the banks. So when you have a recession in an industry that just those banks exclusively focus on or over focus on, that's going to be bad for those banks. So if we have a macro US recession, that's going to be bad for some banks. And so if the Fed has to keep hiking into that scenario because of inflation, I think then we start to worry about which banks. I mean, if the Fed can't offset with interest rate cuts, I mean, there's a risk we get another SVB weekend. I still think, to the extent this thing risks like going systemic, meaning like, okay, now we are worried about Bank of America. I think at that point the Fed can probably cut rates no matter what's going on with inflation, because to the extent you're talking about a big bank like that, it's hugely deflationary. But we could get another SVB weekend where we sort of have a regional bank, that really gets squeezed by a combination of recession and interest rate risk. Like we've had a lot of interest rate risk. The credit risk thing is still kind of out there.
Yeah. And when you say credit risk, can you explain what that means?
Meaning like, well, a lot of people have been talking about commercial real estate, but really just losses, on assets that are driven by inability to pay back loans and assets. And it's slightly different than, a pricing change based on interest rates, which sort of revalues everything to the downside. The credit risk story is really, okay, now we have defaulting customers.
Yeah.
Or even the perception of it. I mean, that's the thing too. Like a lot of AAA MBS paid out over time, but the perception of it is enough to take down a bank.
Yeah. And during this SVB debacle, we saw a lot of activity on Twitter, like where VCs were tweeting and freaking out. Do you feel like social media risk is something, like even Bill Ackman and his doing a short or whatever? Like, do you think about that?
I don't think it matters to the extent it's gotten credit. I would be more impressed by Twitter's ability to cause a bank run if any of these banks had been random. If like Elon tweeted something and all of a sudden Goldman failed, then I would get it. I'd be like, okay, like this is a problem that bank supervisors need to be thinking about. But like none of the banks that it happened to were random.
Yeah.
The other thing to say is like shorts are always loud on Twitter and stuff doesn't happen. I mean, the Credit Suisse scenario started on social media in October 2022, and the bank didn't fail till March. I'm skeptical of looking at a systemic crisis and saying, oh, because we saw tweets, therefore it must have been contributing to the run. I mean, the other thing is like Twitter is really like, I don't think that corporate treasurers are like getting their information first from Twitter. I think they're probably hearing about their bank, before it goes viral on Twitter. And that's really how bank runs happen. Like we don't really have the old quaint bank runs anymore where people go line up and get their $10,000 back because we have deposit insurance. So bank runs really are institutional, and institutional bank runs just don't happen because of Twitter and because of banking apps. Like Amazon is not withdrawing $300 billion on the treasurer's phone. Like, it's just not happening that way. So maybe it matters at the margin for retail, but I don't see it really changing the story for what was ultimately just bad banks.
Yeah. Yeah. No risk officer at the bank kind of
Right, right,
banks. Yeah. Yeah. And
right.
so for you, like, how did you get into this? Like, what's so exciting about risk? And like, I mean, obviously it's very exciting, but for you, like, what's so exciting about it?
I mean, it was 2008, and that
Yeah.
response that, there's sort of a famous story, for people who have seen the movie or read the book Too Big to Fail. There's a famous story where, um, it's right after the Fed rescues AIG for the first time. They do an $85 billion loan. That's a crazy story, by the way. They had like literal collateral in shopping carts, like down the street, like
Oh my gosh.
briefcases. It was like to get like physical securities to the Fed, so
Yeah.
they were protected. Crazy story, but anyways, so the Fed lends $85 billion overnight, to AIG, an insurance company, and Ben Bernanke is talking to some senior folks in Congress about this, and Congressman Barney Frank says, "Where did you get $85 billion?" And Ben Bernanke says, "I have $800 billion." Because the Fed has an infinite amount of money, right? And so, but very much that attitude and that sort of truth really drew me to this of like, okay, there's a lot that can be done. There's a lot of interesting policies sort of that can happen in a crisis. And we're talking about the difference between, a run-of-the-mill recession and the Great Depression. I mean, if you superimpose the policy decisions made during the Great Depression over 2007 and 2008, we probably have a worse depression. And so it was really, I mean, it was a lot of wandering around in the dark back then, but they did a much better policy response. And so to the extent we can improve upon that, I mean, the other thing is that there's basically always a financial crisis going on somewhere in the world. I mean, this is sort of the IMF's reason for existence
Yeah.
still. A lot of it is sovereign debt, which is a little bit different. That's a lot of what the IMF deals with is sovereign debt crises. And we kind of don't think about that as much, although, people have been thinking about it more in developed markets. But there's sort of always a financial crisis. And so the idea that like we can write down some rules on a piece of paper and say, okay, we've stopped all financial crises is just, I mean, it's a fantasy. So there's just a huge economic gains to thinking about crisis fighting and what happened, how you can arrest a crisis. And so that was really the appeal, I think, more than like, okay, I'm going to write some paper that's going to help add like 0.1% to consumption GDP or whatever. It's like, this is like a huge first order problem that we shouldn't be skipping over to get to fancier economic problems.
Yeah. Yeah. And so do you think like so is there a world where we do solve all of this, or is it just like
No,
human nature, yeah, to never
I
solve
mean,
it?
it's human nature and it's the structure of banking. I mean, I would say best case scenario, you're taking the crisis risk from 0.5% to, 1/3 of 1%. Like that's kind of the goal. But also it's really where we have been making big strides and what we're focused on here. But the strides started before we started, in fairness, is can you arrest the severity of a crisis?
Right.
And the attitude has just changed so much. I mean, there was so much in the Depression that was like, oh, recessions are good. The gold standard is good because it sort of drives out bad businesses and things like that. And you still get a little bit of this attitude, people saying the Fed should hike more to get rid of zombie companies and
Yeah.
things like that.
Sure.
But there's just huge gains in allowing some financial stress to play out. But again, it's can you cut off that left tail? Because when you have a financial crisis, even 2008, where the left tail eventually got cut off, I would say, we avoided a Great Depression, which we should have had based on the financial, indicators alone. But it was still really a horrible recession, and you still get things like Donald Trump that come out of that, right? I mean, there's just so many social gains to be had from avoiding a severe crisis. I mean, it's just not a linear relationship of ills from a recession to a really bad recession. It
Yeah.
really goes non-linear, all the social ills that come from a severe crisis relative to sort of a run-of-the-mill recession. And
Yeah.
so to the extent you can arrest a financial crisis at the point of, okay, moderate recession or no recession, you can provide a lot of economic and social value.
Yeah, the economics, like the social value, I think is sometimes not talked about as much as like how do we, just make sure people are okay, because if they're not okay, it really shows up. And this will be my last question, and it's a silly one, I guess, but like, do you think that we're headed towards a recession?
Uh, I don't know. Again, I would say like I would say I don't know if again we're talking about are you talking about 5% negative, like negative 0.5% GDP growth? I have no idea. Like we honestly could be in one already, the way GDP gets revised. We just don't know for several quarters after often if we're in a recession. But talking about, I can talk a little bit about, are we at risk of a severe crisis? And like I said, I think the tinder is out there a little bit, but I don't see the policy response dropping the ball, especially because so much of the banking stress we're in now, again, putting March aside and those banks that were special in the way that they were, so much of the stress we're in now is about the level of interest rates. And that's unique, I think. When we're talking about like a 2008, which was so driven by toxic assets, or we're talking about 2020, which is so driven by this pandemic and this economic shutdown, cutting interest rates, which the Fed is great at, really wasn't going to do anything. Like it wasn't going to make you feel better about subprime or securitization in 2007, and it wasn't going to make you feel better about the pandemic in 2008. It can do a lot, like it very mechanically reprices every financial asset. So to the extent you can cut interest rates, the Fed really has a nuclear option on a severe recession right now, which I think is good. And the other question is like, the other reason this question of are we going to be in a recession or not is hard is the Fed is maybe willing to tolerate one right now. In a way that they're not always, like in 2017, they're just not willing to consider recession risk. And right now they have to think about inflation. And so there's a chance that they say, all right, yes, we got a quarter of negative growth, but that's kind of the reality of fighting inflation.
Yeah.
Makes it harder.
Yeah. No, definitely. Well, good. I mean, yeah, there's really no way to talk about it without being like, I don't know. And I think that's the really hard part about economics is that a lot of it is just, I don't know, but I think, right?
Yeah, and it's I don't know, but what can you do in the event of such?
Yeah.
And that, I mean, that's the important thinking is like, are you prepared for those kinds of environments?
Yeah. Well, thanks so much, Stephen. This has been a great talk. Where can people find all your work?
You can Google the Yale Program on Financial Stability. We have all kinds of things. I have, as you noted, a Substack, withoutwarningresearch.com, which is always free. And then I'm on Twitter still. I might be one of the last people. I'd be the last one, I think, on Twitter because I get too much value out of it. At Stephen Kelly 49.
Awesome. Thank you.